Hi, my name is Fulton Abraham Sanchez. I am the CPA of the firm Fast CPA Consultants, and today we're going to speak about how elites execute their real estate tax strategy. There is a case of a famous billionaire who was able to deduct $30 million loss for the sale of a specific piece of real estate, a real estate property. Now, the case is very particular because even though he purchased this real estate overpriced for $64 million and apparently was a personal property like a vacation home, he was able to classify the transaction as an investment property. So the key to this deal is the classification of the property as an investment, even though it was his residency, meaning that he was living there. It was part of a large estate that he purchased the property. Now, the key is he held the property instead of personally at his name through an LLC. So that was the first step that he took in order to take this deduction whenever he sold the property. Second, he purchased the property with an overprice of $34 million. The appraisal of the property was $30 million, but he paid $64. According to the news, he was so eager to hold or to own this piece of property that he clearly overpaid just with the objective of having or extending the estate extending his estate. Now, whenever he sold the property, he sold it at the appraisal value of $30 million. So the loss was $34 million. Now, we have to remember that whenever you sell your residency, whenever you sell your residency and you make a loss, you are not able to take that loss in your income tax return as a deduction. And whenever you have a gain of the sale of your residency, the primary residency, you don't pay taxes either. So it's like one, it goes in tandem with the other. In this case, by holding the property in an LLC and classifying the property as an investment property, he was able to take the full deduction. In tax principle, we have to remember that whenever there is a main residency, even if it's a vacation home, and you hold the property and you hold it in your name in like a residency, there is no deduction. But things change when you have an investment. When you hold an investment property and you keep it in an LLC, when you sell the property, you will be able to deduct the loss. But remember, whenever there is a real estate loss, it's only matchable to a real estate gain. So whenever you have an investment property and this investment property is sold, there is another side that you can also take the deduction if there are gains for the real estate, from the real estate side. So this is like commensurate with the real estate property sale and loss with the real estate property gain from another side. This is the virtue of this strategy, that by holding the property in real estate property in a company, in an LLC, and particularly this LLC was classified as an S corporation, he was able to maximize the deduction and match it with some other real estate gains that he held, and then when they were sold, they made profit. So it's like a matching thing between the sale of the loss and the sale of the gain, and then this is when the loss was taken and benefit him in the tax return. Now, in a summary, it's like whatever he overpaid the overpriced property, whatever he overpaid for the overpriced property, he was overpaying for the property and then taking the money, taking that overprice, that price that he overpaid, taking it in the future as a loss. The case is even more particular because the owner of the company, the CEO of the company that produces the taxes for this billionaire group, even report that to the IRS through a whistleblower line that the IRS created even though the IRS was aware of a transaction, the case was dismissed. So it's very particular in this case because the IRS was aware of this transaction. But it seems also that the IRS, even though it was reported, the IRS concentrates more not in real estate capital gains, but more in auditing regular income. That was the appreciation of the news outlet that created and reported this article. So it's very particular the case because even though this was whistleblown to the IRS, the case was dismissed. And previously, the IRS has audited this billionaire group, the group of the companies. And even though the IRS was again alerted about the misclassification of U.S. profits reported as offshore profit, because in the past, before profit from foreign companies were reportable, but they were not taxable. After the tax reform, they are reportable and taxable. So before that, 2011, 2012, the IRS audited this group. But even though this particular misclassification was whistleblown, the IRS didn't take any precaution, didn't take that into account, and nothing happened, even though they audited this billionaire group. So it's very particular when there is this kind of tax planning for this real estate from 1 year to, let's say, 5 or 10 years. There is a lot of consideration in terms of how to classify vacation homes or personal residency as investment property, particularly when there is an LLC vehicle involved. If you want more information about these topics, you can check our channel here in YouTube. You can also subscribe to receive more videos about this topic. And if you have particular specific question about this topic, you can check on the link here in the description box and send us an email. Fancy PI Consultants. Thank you.